Okay, so this chapter is called accrual accounting, income and accounting, right? So everything that you've learned to date is accrual basis accounting. I am not surprising you with anything. I am not trying to trick you with what we learned in chapters 1 and 2. Everything you've learned to date is accrual basis accounting. We're just putting a name to it now. So there are two bases of accounting, and what we live in is a world of cash basis. We are most familiar with cash basis because most of us rely on cash to live. So we need to know how much cash is coming in each month and how much cash is going out each month in order to know if we can pay for our bills and afford what we want to purchase, right? So it is kind of confusing when you start to learn accounting because our world is, for the most part, a cash basis world. So I'll start with cash basis and just kind of identify the difference. Cash basis, we only record cash transactions. So amounts that are owed to us or amounts that we owe aren't recorded. We don't really have very many assets because we don't record them. We don't have liabilities because unless we pay for something, it's not going to be recorded. With a cash basis, how we record revenue is when cash is received. On a cash basis, expenses are when cash is paid, not necessarily what happened with the transaction or in the month or period of time that the transaction actually happened when we actually earned revenue. So the financial statements on a cash basis are incomplete. They can be easily manipulated period to period. So it doesn't give a true understanding of what's happening for this company. GAAP does not allow us to use a cash basis. Everything you've learned in this class so far is an accrual basis. So with accrual basis accounting, we're recording the impact of transactions when they actually occur. So when did I provide the service to my customer? I'm going to record revenue when I've provided that service to my customer or the goods to my customer. I don't care if they paid me in advance. I don't care if they paid me when this transaction actually occurred, or I don't care if they're going to pay me later. Doesn't matter when the cash comes through to recognize revenue. What mattered was when did I actually provide the service to recognize that revenue as earned. And that's when I'm going to record the transaction. The same thing goes. What was that?
Would there be a reason for cash basis accounting?
It's easier and people understand it. But if you want GAAP-based financial statements, if you want to take out debt, if you want sophisticated investors, you have to use accrual basis. If you go out for a loan with the bank will require that you use accrual basis accounting.
Yes. So is cash basis used anywhere other than for us to keep count of
for businesses that don't need funding?
Okay.
So small businesses that don't have accountants typically use a cash basis. But if they intend to go to a bank to get funding, that process of converting from a cash basis to an accrual basis after they've been operating on a cash basis or semi-cash basis for years is a pain, and it's extremely expensive. I've been on audits where those clients should not have even gone out for an audit, but they needed the funding and they had to get an audit. And it's extremely expensive for them to convert it to from a cash basis to an accrual basis after those years of operating like that. Okay. So it's best to just start out on an accrual basis. For expenses on an accrual basis, we're recording our expenses as they're incurred. So in the period of time that they're actually incurred. So when did my employees work for me and earn their salary? That's the period of time that I'm going to record their actual salary expense. Not if they get paid next month, but they worked during August. So even though they're going to get paid in September, they worked during August. We incurred the expense in August, and that's when salary expense is going to be recorded. If I don't pay them until September, then I'm going to have a liability, an amount that I owe to them at the end of August. And we're going to have to accrue for that liability. And that's what we're going to talk about partially in this chapter, are those time periods that are separated, where one transaction happens, we incur an expense in one time period, but we won't pay it until a different time period. Generally accepted accounting principles require us to use accrual basis accounting to get a complete picture of all of the transactions that have happened during a period of time, to get an accurate reflection of the revenue that's been earned during a period of time, the actual expenses that have been incurred during that period of time, and to really know and identify the true net income of that company for a period of time. Marisol, you have a question?
So even if you start a small business as a freelancer, you should just start as the accrual basis. Like, don't even
Yes,
do the cash basis.
I recommend that.
Okay, thanks.
Because you don't know how big you're going to grow, and at one point you're going to want some additional funding. Okay. From here on out, you can ignore the cash basis. Cash receipts and cash payments do not mean revenue or expenses in this class. You can completely disregard that. Think about when the transaction happened. When did we actually earn the revenue? When did we actually incur the expense? That's what your focus is on this class. For the time period concept, I've kind of hinted at this for a number of classes, but accounting is reported in regular intervals. So we don't just have financial statements that are for 10 years at a time and we're reporting our net income for 10 years. We're reporting them regularly, at least once a year, sometimes more frequently than once a year, but at a minimum annually. If it's a publicly traded company, their annual report is referred to as the Form 10-K. It's an SEC filing. For the time period concept, about 60% of companies are calendar year-end companies, meaning that their fiscal or their calendar year-end starts on January 1st, and their year-end date is December 31st. So a good chunk of companies do have calendar year ends, meaning that their busy season or when they need their audits prepared is during the first 3 to 4 months of the following year. That's when we're expected to turn around those financial statements and get them out to their investors and creditors. For a company that has a year-end date other than December 31st, it's referred to as a fiscal year-end. So fiscal year-end, June 30th, common in education. A lot of our schools have a fiscal year-end of June 30th, partially because of federal funding. And the federal government starts their funding period in July 1st. So we have a July 1st to June 30th. Public accounting firms typically have April 30th as their year end because the last 3 months, that last quarter, is our busy season. That's when we bring in the most revenue. If I'm talking about a retail establishment, they typically have a January 31st year end because of that busy holiday season. Being that fourth quarter, they get the most bang for their buck, if you will. Some of the tech companies have September 30th, and it probably has to do with just a ramp up of technology needs from companies as well as individuals right before school starts.
So accountants are busy all year long.
Yeah. Now, if you're thinking about forming a business and you know eventually you're going to probably need an audit, if you want to save a little in your auditing fees, don't have a calendar year-end company. Because, yeah, we're busy all year round, but December 31st year-end companies are our busiest because most companies are calendar year-end companies. So save yourself a little money in the long run if you just choose a different year-end. For revenue recognition principle, it's gotten a lot more complicated in the last several years because of the new revenue recognition principle that's come out. But in general, what you need to know for this chapter, at least, is that revenue is recognized after it has been earned. So a company has to do something first in order to recognize revenue. I have to provide the goods to my customer. I need to transfer title to those goods to my customer, meaning I no longer own those goods before recognizing revenue. Or I have to perform a service before I can recognize revenue. I can't recognize revenue before that point. My customer might pay me in advance. If they pay me in advance, it's referred to as unearned revenue until I perform that service or provide those goods to my customer. The amount that we're going to record is the agreed upon sales price. So you walk into Target to the dollar section and you find an item that's $1 and you go to pay for that item. That dollar that you're paying plus tax, but we'll get to that later, but that dollar that you're paying is the agreed upon sales price, the cash value of that good that's been transferred from Target to you, the customer. Marisol, your hand's still up. Do you have a question still?
Oops, no, I'm just not very good with
No worries,
computers.
I lowered it. No worries. Terry, signing a contract does not count as earning revenue at that point in time. You have to do something to perform. You have to perform something based on whatever's in the contract. So contracts get really complicated, and our new revenue recognition model kind of gets into that, but there might be multiple performance obligations or things that you have to do before you can earn a certain amount of revenue. So we'll talk about contracts at a later point in chapter 5. The expense recognition principle is something that you definitely want to be aware of. It's sometimes referred to as the matching principle. So expenses are the cost of assets used up and liabilities created in earning revenue. So we've heard it as a different definition, which is the cost of operating the business, but it can also be referred to as the cost of assets used up. So when I use the supplies or I sell the inventory, those are assets that I've used to earn revenue. And liabilities created, meaning that my employees have worked for me during a period of time, but I haven't paid them yet. So I have salaries payable when I recognize that expense, salary expense is incurred. Eventually, I have to pay my employees for those expenses that all their salary that they've earned during that period of time. So with the expense recognition principle, there's 2 steps. We're going to identify all the expenses that are incurred. Employees work. I use the utilities. I use the office supplies. That's that word incurred. So we're doing something with that. I use that fixed asset during the period of time to produce my goods. Incurred. And we're going to measure the expenses. So figure out how much was incurred during that period of time. A month, it could be a quarter, it could be a year that we're talking about. And recognize them in the same period in which the related revenues are earned. That's where you get the matching principle. So I'm have these fixed assets to produce the goods that I will ultimately sell to my customers. Because I have these fixed assets, over time, they eventually you have wear and tear on those assets. So we're going to depreciate those assets over their useful life, matching the revenue that's being generated from using those assets against the expense, depreciation expense, so that we can get an accurate value of net income for the period. As my employees are working during the period, they're helping me sell the goods. They're helping me sell services to my customers. I'm generating revenue by having these employees, matching the salary expense with the revenue that's being generated from them working. Does that kind of make sense? Yes?
It does, yeah.
Okay. Jonathan, yes, everybody's quiet today. It's Wednesday. Usually I have this issue in Monday's classes.
I need
Maybe
to get tested for COVID, so that's fun.
Oh, sorry. Well, maybe everybody has like midterms right now, so I'll just leave it at that. I won't take it personally. Okay. Do you guys want to practice some journal entries?
Yes.
Okay. Okay. So before we get to our adjusting entries, before we get to the fun of chapter 3, we're going to start here. And I just remembered I forgot to upload the chapter 3 handout. So I will attach the chapter 3 handout for you right after I pause my recording. But I didn't do this. Sorry, you guys have to remind me to push the record for sometimes. So cash is increasing because we're collecting it. So I'm going to debit cash because it's increasing.
Mm-hmm.
What's the second account that's impacted by this one?
The service revenue.
So have we performed the service yet?
No.
Remember?
Is it a liability?
We have not. It is technically a liability, and it's a new liability account. And I'm going to check the chat to see. Unearned revenue, correct. So unearned revenue is also referred to as deferred revenue. It's the same thing. It is a liability because now we don't have an obligation to pay. We have an obligation to perform that service. We have to provide them with that party in the future. So that advance payment for a party is unearned revenue.
What did you say the other name was? Unearned or what?
Deferred, D-E-F-E-R-R-E-D.
When are we going to be using for this class?
In about 20 minutes.
Oh, no, I asked what name are we using? Deferred revenue or
Oh,
unearned?
we go back and forth.
Okay.
Sorry. So unearned revenue is a liability. So it increases with a credit. And it's an obligation to perform a service or provide goods to our customer in the future. A common unearned revenue or deferred revenue is gift cards. When you purchase a gift card, it's not revenue for that company. They get cash flow from you from purchasing the gift card, but in order for them to recognize revenue, you have to come back in and purchase goods or use their service in order for them to recognize revenue. So they have an obligation to allow you to purchase those goods with that gift card. So in this particular case, we're going to debit cash, increasing cash for the amount we collected, 2,000,
2,000
and we're going to credit unearned
for revenue.
revenue, increasing the liability by 2,000.
2,000.
And unearned revenue for the most part is usually going to be a current liability. Okay, number 4. Geller paid her assistant $400. So we can start with the paid portion.
It's an expense.
It's going to be an expense, but not because of the paid.
Salary expense.
Salary expense, and then what's the paid telling us?
Cash.
Cash
Cash.
decreasing for 400.
So cash is decreasing, and then salary expense, correct. Since cash is decreasing, am I debiting or crediting cash?
Crediting.
Crediting, because cash is an asset. It's decreasing, so it's a credit to cash, decreasing the cash account by 400.
Professor Wade,
Yes,
so whenever cash is decreasing, it's always going to be a credit?
correct.
Okay.
Every single time. And for the debit, the expense type, because her assistant worked for her, that means it's implied it's salary is expense. Think about your own pay. You're not getting paid until you actually work. So you've incurred that expense, or the company has incurred the expense because their employee has worked for them.
And what account does that go under? Expenses?
So
Or-
salary expenses and an expense account. Correct.
Okay.
Expenses increase with a debit. You're pretty much always going to debit expenses with a few rare exceptions in this class.
Gotcha.
I had a
Thank you.
question. I had a question.
Tristan, yes.
What is it if it's always how do you know if it's a credit again?
For what?
For the question you know, because he asked like how do you know if it's a credit, and you said if it was trying to think.
Are you talking about cash?
Yeah.
Okay. Cash is pretty much all of your accounts have a reason why you're debiting or crediting them. Cash,
Okay.
when you collect cash, cash is coming in.
Yeah.
So you always debit cash when you have collections of cash.
Okay.
For cash paid, whenever you pay out cash, you're always crediting cash, reducing cash.
Okay. So pretty much decreased cash is credit.
Always.
Okay. And then positive cash is debit.
Yep. Cash coming in is always a debit. Cash going out is always a credit to cash.
Okay.
And Jason, yes. Okay, number 5. Geller purchased $250 of supplies on account. So what are the two accounts impacted?
Supplies and accounts payable.
Supplies and accounts payable. Supplies is what type of an account?
Asset
Asset.
Supplies is an asset. And did the asset increase or decrease?
increase for 2050.
Increased. We now have supplies available to be used in the future. And accounts payable is what type of an account?
Liability.
A liability. And the liability is increasing.
Increasing.
Increasing. We now have an amount owed to our vendor. So we're going to debit supplies Increasing the asset account. So this is important. Supplies, just supplies, when we purchase supplies, is an asset.
Could you move the screen down a little bit?
Yeah. Better?
Yes.
So when we purchase supplies, it goes into the asset account. We haven't used the supplies yet, so we have it to be used in the future. We're debiting the supplies account for $250. We now have $250 worth of supplies to use in the future. And we're crediting accounts payable. We now have a liability, so we're increasing the liability for $250 because we have an obligation to pay our vendor. So I'm going to write another T account for supplies.
And Professor Wade,
Yes,
when it means on account, that means you don't pay it right away, right?
correct.
Okay. Just
So purchases on account are always accounts payable. Meaning that you owe that amount and you're going to pay it later. So for my supplies T account, we have a beginning balance of 0. Now we've purchased supplies and we have $250 of supplies available to be used in the future. Number 6, Geller paid $220 for the supplies purchased on account. What are the two accounts?
Accounts payable and cash.
Yep, and I am watching the chat. I am watching that you guys are saying it correctly too. Accounts payable and cash. So on account and then this paid is implying that we're paying off an amount that was owed, right? Why was the supplies account not impacted?
Because we already had them.
We have the supplies, so we're not purchasing additional supplies, right? And we're not using the supplies. So the supplies account stays unchanged. But accounts payable is going to decrease, right? So we're going to debit or credit accounts payable.
Debit.
Debit accounts payable, reducing the liability because it's partially being paid off, right?
Scroll down a little bit, please.
Yes.
Thank you.
We're reducing that liability because we're paying off part of what's owed to the vendor. And we're going to credit cash because we're paying out cash for $220. For number 7, the utility bill was received, but will not be paid until next month, $50. So we've incurred the expense, but we're not going to pay it until next month. So it's not a deferred expense. It's an expense, but we're not going to pay it right now.
It's a utility expense and accounts payable.
Correct. So it's utility expense. We've incurred the expense, so we need to recognize that expense is incurred in the month that we use the utilities. So we're going to debit utilities expense. And you know that they're sending you that bill after you've used those utilities, not before, because they want to get all of that amount from you for what you actually used. So we're going to debit utilities expense for $50, recognizing that expense of those utilities we used, and we're going to credit a payable account. It can be accounts payable. It could be utilities payable. We'll just use accounts payable for now.
Okay.
But I would accept utilities payable as well. So accounts payable is increasing. We now owe $50 for that bill for those utilities that we used this month. 2 left. Number 8. Christian, do you want me to make the T account for accounts payable, or are you asking if you can make one for accounts payable? Okay, so you want me to show you. Okay, for accounts payable, Christian wanted just to see the accounts payable T account. So let's see. Obviously, the beginning balance would be 0 because we started with 0. Accounts payable increased by 250 with number 5. Then it decreased by 220 in number 6. And then it increased again with number 7. So 250 minus the 220 gives you 30 left. And then 50, so the balance should be 80. Is that what you're showing? Okay, perfect. For number 8, Geller purchased a computer to keep records for her party business, $1,000. Ignore depreciation. Well, we ignore depreciation at the beginning anyways, so.
Would that be an asset?
It is an asset, correct, because the computer, we're going to use it for years. So we're going to debit
Computer equipment.
computer equipment, computer
Supplies.
alone, or just equipment is fine. I would accept any of those 3. So we're going to debit. I'm just going to use computer. If you include the word expense next to computer, it is wrong. Computers are assets.
Which 3 did you say you would accept?
Computer, computer equipment, or just equipment.
Okay.
Not supplies.
It is not supplies. Supplies are current assets. Supplies are things like, where is it? Staples. I just threw staples somewhere on the ground. Pens, pencils, tape, etc. Things that you pull quickly, paper, use, and it's gone. Computers, equipment, vehicles, those are more tangible. You're not just pulling a computer and then throwing it away the next day.
So kind of like long term?
Those are long-term, correct.
Okay.
So computer is going to be debited for how much?
1,000.
1,000, the historical cost, and we're going to credit
Cash for 1,000.
cash because it said purchased and it didn't say on account. So we're assuming it was cash.
Mm-hmm.
Reducing cash by 1,000.
If it was on account, would number 8 have to say on account or paid in advance or later on?
Yeah, correct. It would have to say something like that.
Okay.
Christian, trying to think. Not all assets have a physical, they're not all durable. We'll talk more about it later, but most of them are. But think of it as they're providing a future benefit for the company. That's what an asset is. So, Jason, to answer your question, computer equipment together is 2 words or just equipment? Okay, this last one is a new one. So technically number 3, 7, and then 9 are the new ones. For number 9, we adjusted for the supplies used during the period. Geller had $10 of supplies left. So Geller had $10 of supplies left. Does that mean that that's how much she used or how much our ending balance of our supplies account should be?
How much she ended
Imbalance.
balance for the month?
Ending balance. So this is very common. If any of you have worked in a restaurant before, you know that you're requested to do either weekly inventories, and you have to record how much alcohol is in each of the bottles, how much food you have, etc. And then they update their inventory list. Well, guess what they're doing with that difference? They're figuring out how much was used. Similar concept. So we're kind of backing into how much was used by using how much is left over. So we have $10 of supplies left over to be used in the future. So we're trying to figure out the credit for the supplies used during the period, our supplies expense. Yep, it makes sense why you're doing it almost daily now. Less for the accounting side, more for the operational side. For beginning balance, we have 0. We add the $250 of purchases, right? Then we subtract out what we still have left over because we didn't use it. So how much in supplies did we use?
240.
2040.
240. Correct. So what am I going to debit and what am I going to credit? You already know the credit side, right? We already know that the supplies account needs to be credited for
Supplies expense and supplies.
correct. So supplies is going to decrease. The asset is decreasing for the amount used. It's no longer available to be used in the future. We've incurred the expense because we've used it. So we're going to debit supplies expense. Increasing
240, right?
correct. Increasing the expense for the amount used.
Could you also call that inventory expense?
No, because inventory is what you sell. And when you sell inventory, it's cost of goods sold.
Got it.
Good question, though.
Could you scroll down a little bit?
Yes, I will. So these are the supplies that we use during the period. That's what we're expensing. These are tough. You haven't done the homework yet. You haven't practiced journal entries except for in class, last class. And the more that you do journal entries, the more familiar you'll become and the less scary they'll be. We're going to take a break here. So come back in 10 minutes. Okay, so before we jump into the adjusting entries, I just want to refresh on kind of the accounting cycle. And we already touched upon some of it, or the flow of information last class, where a transaction occurs, then we analyze that transaction, right? We record it in the journal with our journal entries, post those journal entries to our accounts, the T accounts. It gets summarized in the trial balance, and I'm going to add some new terminology to that. That summary of the trial balance from what we just did last class is referred to as our unadjusted trial balance, meaning that not all of our accounts are correct at this point in time. They're not up to date because there are a lot of transactions that we kind of ignore during the month because it's a pain in the butt and not worth our time to go through and record every single pen that's taken out of our supply closet during the month. Okay, if I'm talking about a restaurant from an accounting perspective, not from operational perspective, because that's different, but from an accounting perspective, it's not worth my time to figure out the ending inventory balance every single day or figure out how much in inventory we used every single day. So I'm not going to do that until the end of the month to make sure that I record cost of goods sold, that inventory we used during that month. So what that means is that our trial balance, if we were to prepare our financial statements based on that unadjusted trial balance, is that we would be missing some revenue that we didn't record. We'd be missing some expenses that we didn't record. So net income wouldn't be accurate from that unadjusted trial balance. And our assets and liabilities also would not be correct. They may be higher or lower than they should have been. So at the end of the month, after the period has ended, usually during the first few days of the next month or the next period, we're going to go back and we're going to adjust the trial balance by preparing adjusting journal entries. And today that's what we're focusing on, is the journal entries to make sure that our income statement is up to date, our balance sheet is up to date, and that when we prepare our financial statements, they're accurate and reflected as such. So our unadjusted trial balance shows the beginning balance of some of these accounts. And then our adjusted balance is going to show, or our adjusted trial balance is going to show the changes, our adjusting entries that we made, and then the adjusted balance of these accounts. If we don't have any adjusting entries, then the unadjusted balance is the same as the adjusted balance. Once we have that adjusted trial balance prepared, then we can prepare our financial statements. And all of that has to happen before we can prepare financial statements. So basically, we just walk through chapters 1 to 3 right here. The very last part of our accounting cycle is closing out the books, which is what we're going to talk about at the very end of next class. But basically, we have to close our books to get this whole process started again next period.
It's like painting the Golden Gate Bridge. It takes a year, and then when they're done, they start painting it over again. It never stops.
Pretty much. That's the accounting cycle. So what you needed to know is that we're going to be talking right here about the adjusted trial balance, or sorry, the adjusting entries and the adjusted trial balance. So, sorry. With our adjusting of the accounts, we're recording these entries as of the last day of a period. So in some of the examples that you're going to look at, it's the last day of their year, their fiscal year or their calendar year. In some of the examples that we're going to look at, it's the last day of a month. So you need to figure out the time period that the example is looking at, because that will make a difference in the amount that you're going to be recognizing and adjusting for. There are 3 types of adjusting journal entries that we're going to look at, and these are manually prepared. So an accountant is preparing these. It's not prepared by the system like a lot of our journal entries. We have deferrals, depreciation, and then accruals. The purpose of adjusting entries is twofold. The first is to measure income, meaning that all the revenue that was earned during the period is reported. All of the expenses that were incurred during the period are reported so that we can accurately calculate and report net income for the period, or net loss possibly. The second reason is to make sure that our balance sheet is up to date. meaning that we're accurately reflecting the company's statement of position. Where are they at? How much in total assets do they have? And how much in total liabilities are owed as of the end of the period. So we're making sure our assets and our liabilities are up to date. Every adjusting entry, this is important to reflect on. Every adjusting entry affects at least one asset or one liability account. So at least one asset or one liability account. So there's my balance sheet being updated. And at least one revenue or expense account. There's my income statement being updated. Cash is never adjusted.
It's just reported, right? Never adjusted, just reported.
Cash is
Or-
never adjusted because with these transactions, we're reflecting on, we may have received cash in advance. And so now we need to recognize the amount of revenue that we've earned during the period.
So we report the
Cash
cash and adjust the cash because it is what it is.
Cash is what it is. You already know the balance of cash. Cash doesn't change with adjusting entries. Same goes for the expense. You've incurred an expense during a period of time. You haven't paid for it yet. So you're not going to pay for it until later. Cash doesn't change. So cash is never adjusted. We're going to focus first on deferrals. And with deferrals and accruals, these are opposites. With deferrals, the two examples that we have and the asset and the liability side of it that are impacted are prepaid expenses and unearned revenue or deferred revenue.
Professor Wade, when it says cash paid or received, can it be an and or is it or?
It's or.
Okay.
So a prepaid expense is an asset. So it has a normal debit balance. It increases with a debit. And a prepaid expense is an expense paid in advance. So we've paid for an expense in advance of owing for that expense, in advance of incurring that expense. A common one would be insurance. A lot of insurance carriers require us to pay a year or a quarter's worth of insurance in advance. We haven't used the insurance yet. The time period hasn't even passed yet for when it relates to that insurance policy, but we have to pay for it in advance. It's a prepaid. It's an asset. It's providing us with a future benefit, meaning we have insurance to use during that year. For a deferral, and I'm not going to get into the definition of unearned revenue yet, but deferrals means that cash is paid or received in advance of incurring that expense in the terms of a prepaid or earning revenue in terms of unearned revenue. So with deferrals, you're typically going to have two entries. One entry that's establishing that prepaid or unearned account, and then the adjusting entry to reflect the amount of expense that's been incurred during that period or revenue that's been earned during that period.
So
Professor, I
that's
had
a liability?
One more time.
Is that a liability?
The prepaid or the unearned?
The unearned revenue.
Unearned revenue is a liability. Yeah.
Professor, I had a question.
Yes.
So it's a for deferrals. Is it in advance of an incurring an expense? So what exactly does that mean? Incurring an expense?
So with insurance,
Yeah.
when the time period has passed, you've incurred it.
Oh,
So
okay.
if I have a policy from January to December and I paid for my insurance policy for that year in November of this year,
Yeah.
as soon as January 31st has passed, I've used 1 month of insurance.
Okay.
You've incurred it.
Okay. Thank
Yeah.
you.
Mm-hmm. So we're going to look at prepaids first. And we're going to do 2 right now. Suppose a company had the following transactions. On June 1st, they paid 3 months worth of rent in advance. Rent is $1,000 per month. So we're going to record this journal entry. It's not the adjusting entry because it's happening at the beginning of the month. But 3 months of rent were paid at how much per month? $1,000 per month. So how much did we pay?
3,000.
3,000. On June 1st, did we use that rent? What is this time period related to? It's June, July,
August.
August, right? 3 months worth of rent that we're paying for. So we're right here, June 1st. We haven't used this rent yet, correct? We haven't used this facility yet.
Not yet.
But we had to pay for it.
Yes, in advance.
So we're going to call this account prepaid what?
Rent.
Rent.
Rent. Yep, prepaid rent.
Do you think you could scroll up just a little bit? Just a little bit. That's possible.
How much more?
I've seen the rest of the deferrals like just like the last sentence.
This part?
A little bit up, a little bit up. Yeah, that's fine. Yeah.
Okay.
Thank you.
Yep. Okay, so prepaid rent's going to be impacted with this transaction on June 1st. What else is impacted by this transaction?
Cash.
Cash.
We're paying the 3,000.
Correct. We're paying out cash. So prepaid rent is going to increase or decrease?
Increase.
Increase. We now have that rent to be available for future use. Right?
So.
And cash is decreasing because we're paying it out.
We're paying out.
So on June 1st, we're going to debit prepaid rent, increasing our prepaid account by 3,000. And we're going to credit and reduce cash by 3,000. So right here, my beginning balance for June is going to be 0 for my prepaid rent account. On June 1st, I established this prepaid rent account. I'm debiting prepaid rent, so I debit the T account. And you can ignore the other T account over here for a minute. On June 2nd, the company purchased $700 of supplies. So what are the 2 accounts that are impacted?
Supplies and cash.
Supplies and cash. Both of them are assets, correct?
Yes.
Yes.
Supplies is going to increase or decrease?
Increase.
Increase.
Increase. So supplies, asset account. How do I increase an asset account?
Debit. Debit.
Correct. I debit the account, so debit supplies. I now have supplies to be used in the future worth $700. And I'm going to credit cash because we paid out cash, reducing cash by 700. So the beginning balance, the beginning of June, I'm just assuming it's zero because they didn't tell us a beginning balance. On June 2nd, I purchased $700 worth of supplies. I now have $700 worth of supplies to be used in the future.
Mhm.
Okay. Notice here we've paid cash in advance. On June 30th, what adjustment do you need for rent? I'm not going to ask that right this second. Right now, what's my unadjusted balance? What's my ending balance as of June 30th? My unadjusted balance. If I was to run my trial balance right this moment,
Mhm.
what would the balance of my prepaid rent account be?
2,000.
$3,000, right? Because all I've established is the fact that I paid for rent, 3 months worth of rent. That's all I have. If I was to run my unadjusted trial balance or a trial balance as of June 30th, the balance of my supplies account would be 700.
700.
Realistically, for supplies, did we probably use supplies during the month?
Yes.
Yes. So you know that that account is probably too high right now.
Yeah. Incorrect.
And for rent, we know that if a month has passed, we've used a month worth of rent. So we know that both of those balances are not correct right now. So on,
Do we only record debits? Do we only record debits on the T account, not credits?
no, you're going to see what happens. These just
Okay.
happen to be asset accounts. So when you purchase those assets or you establish the asset accounts, it has a debit. But
Okay.
you'll see. For number one, what adjustment do you need for rent? What does the balance of rent, prepaid rent, need to be? Is another way of looking
2,000.
at it.
2,000. You used up 1,000.
Yes. So the adjusted balance for rent, and there's different ways of looking about it. You don't have to go this way. Needs to be 2,000 because why?
Because you rented for a month.
2 months rent left, right?
Mhm.
We've now used June, so now we still have 2 months worth of prepaid rent left. So that means that for the amount of rent that we used,
1,000. It's
we've
1,000.
incurred 3,000 minus 2,000, 1,000, 1 month worth of rent. So on June 30th, and the other way you can do it is 1 month used times $1,000 per month in rent expense. Gives us our rent that's been incurred this month. You can go either direction with it, whichever one makes more sense. Where am I going to record this $1,000? We know half of it, right? I know that on June 30th, my adjusting entry, this is my adjustment right here. I'll highlight it in yellow because it's happening at the end of the period. this is my adjustment. I know that I'm going to credit my prepaid rent account, reducing the asset for the amount used, the amount incurred during the month. What account am I going to charge this to?
Rent expense?
Rent expense. Exactly. We're going to debit rent expense. Increasing the expense for the amount of rent incurred during the period. Rent expense is an expense. So when we incur it, my unadjusted balance is 630. Before recording this entry would be 0. I would show no rent expense. But we know that they use the rent for a month, so there should be rent expense. So that adjustment for the rent that they used, 1,000 is there. And my adjusted balance at 630 represents the amount of rent used during that month, $1,000.
In theory though, like if we're gonna rent a place, we always pay like first month's rent to get a place, and like usually like at least a deposit, if not last month. Right?
Yes. And then that last month just sits in there as a prepaid for them
Okay.
or for you.
Right.
Mhm. So in my prepaid rent account, what the balance is showing is how much in rent I've paid in advance that I still have for the future, 2 months worth of rent. In my rent expense account, it's showing the amount of rent that was incurred, used during that period of time, during the month, $1,000. Once we've expensed it, it's gone forever. We expensed it, it's reported in the income statement, that's it. We report it once. Is this kind of making some sense?
I need a little more practice on this.
Of course you will. Don't worry. You'll get a practice. Don't worry.
Yeah, I need more practice for sure.
We're gonna be doing a study group right after a class if anyone wants to join. So
Thanks, Terry. Okay. So next one. The company physically counted their supplies and had $400 worth of supplies left over. So are they telling you how much in supplies that you have left, or are they telling you how much in supplies you've used?
How much in supplies left?
How much in supplies left? So is that the ending balance or the
Yes,
credit supplies?
the ending balance.
Ending balance. So my adjusted balance at 630, my ending balance, needs to be equal to $400. The supplies left for the future. And supplies is one of those accounts, they pretty much always give you the ending balance. They don't give you the amount used. So how do I get from $700 as my unadjusted balance to a balance of $400? I need to reduce the account by
Deducting the 400 to
300.
700.
Yep, 700 minus the 400 gives us the 300. Yep.
Mhm.
Supplies used. What's the account that I'm going to record this in? Supplies.
Expense.
Expense, supplies
Expense.
expense.
The expense account. So obviously my unadjusted balance at 6:30 for supplies expense is 0 because I haven't reported any supplies being used yet.
Hi, Mr. Smith, how are you? Doing excellent. I'm actually just
So I need to record those supplies that are used in order to have an adjusted balance at 6:30 of $300. Supplies used. So in my journal entry, I can't just do the T account. It's just showing you what's going on, but I need to actually record it. I'm going to debit supplies expense, increasing supplies expense for $300, the amount used. And I'm going to credit supplies, the asset account, reducing supplies for the amount used during the period, $300. Now, my asset balance is correct. It reflects how much I have in supplies to use in the future. And my expense account is correct. It reflects how much in supplies I used during the period. Something to note, because I've seen this issue in the past, the journal entry shows the transaction value. It doesn't show the balance of the accounts. The balance of the accounts is what's shown in the T accounts. You have the beginning balance, ending balance, and all the transactions that are debited and credited to the account. But the journal entry just shows the transaction value for that specific transaction. It doesn't show you a balance. So obviously this June 30th is also an adjusting entry. Correct. We're showing posting it to the ledger right here. For what just happened with the prepaids and the adjusting entry, with adjusting entries for deferrals related to prepaids, the asset account decreases with the adjusting entry. Which is what you saw happening here. Prepaid rent decreased, supplies decreased. And the expense account increases. Rent expense increased, supplies expense increased. It's a little cheat sheet for you, if you will, to kind of just check yourself when you're recording these adjusting entries. If a prepaid or if it's a deferral, every adjusting entry that's a deferral that involves an asset, the asset account will decrease. Every single expense account that's adjusted for a deferral will increase. Christian, what do you mean they used depreciation instead? Because we're doing depreciation in a bit. Oh, okay. Okay. Questions on either of these two? Okay, if not, we're going to move to unearned revenue and then do a practice problem. Okay. Unearned revenue is a liability account. So it has a normal credit balance, increases with a credit, and it represents collections of cash from our customers in advance of providing a service or providing goods to our customers. So they've paid us in advance of us earning the revenue. We haven't performed the service or provided the goods to our customers, so we have an obligation, liability, to pay or to perform that service or provide those goods in the future. So with unearned revenue, you'll have, again, two different journal entries. A journal entry that establishes that deferral, the receipt of cash, and then you'll have an adjustment at the end of the period to recognize the amount of revenue earned during the period. On June 15th, client A paid ABC Company $400 for monthly cleaning starting immediately. So I like to use visuals of kind of calendars, if you will. And this individual paid for a monthly service that starts on June 15th and ends on July 15th. So partial month, right?
Mm-hmm.
And right here, we collected cash.
June 15th.
Collected $400 from that customer. On June 15th, did we do anything for that customer?
Not yet.
Not yet.
Just collect the money.
Just collected the money. So on June 15th, we're going to debit what? That's the easy part. We collected cash, so on June 15th, we get to debit cash, increasing our cash balance for the amount of cash that we collected, $400.
Wait, so has this service been provided already or not yet?
Not yet.
Okay.
So you're going to start immediately, but we haven't performed anything yet. They just paid us for that month in the future.
Got it.
So on June 15th, since we haven't done anything yet, we need to record that as a liability, unearned revenue. So we're going to credit unearned revenue, increasing my unearned revenue account, my liability account, by $400. So June 1st, we have a balance of 0 in that account. And on June 15th, when we collect $400, it increases that liability account. So as of June 30th, my unadjusted balance in this account would show $400.
Mm-hmm.
Right? Because all I've recorded at this point in time is how much cash I've collected from my customer. With things like unearned revenue, yeah, obviously we're performing that service for them, but we're not going in and daily adjusting this account. We're recognizing daily amounts of revenue. Not worth our time. So as of June 30th, we need to adjust for some revenue that's been earned. As of June 30th, have we earned $400 worth of revenue?
We don't know.
Terry, yes. Here's June 30th, okay? From June 15th until June 30th, you've been working, right? And this contract goes from June 15th until July 15th. So have you earned any revenue between June 15th and June 30th? If you started working immediately.
Oh, yes.
Earned half of it?
Yes, half
Earned
of
half of
the
it. Yep.
amount.
Half a month has been earned. So I can't recognize a whole month's worth of revenue because I didn't earn a whole month's worth of revenue. I only earned half a month worth of revenue. So that's how much revenue I'm going to recognize. So
Okay.
$400 per month is the amount of revenue that's earned times a half a month worked. Oops, I don't want to write there.
Okay. It's not the total because we didn't finish yet complete the work, right?
Doesn't matter because
Okay.
we did part of it, we get to earn part of it. So
Okay.
on June 30th, I get to reduce my liability, right? By how much?
200.
By $200, correct.
So you only get the 400 once you complete the whole thing.
Yes.
That's what it
So
says.
in July, you'll recognize the other 200 related to this month, this half month, and then another 200 if they sign another contract and continue cleaning.
Okay.
Yeah. So June 30th, unearned revenue is going to decrease by 200, and we're going to credit. What's the account that we're going to credit? Service
revenue.
Yep. Revenue account. So my unadjusted balance for service revenue would likely have a beginning balance because you've already earned other revenue unrelated to this contract, but I'm just going to say it's 0 for right now. And now we're going to recognize that $200 as earned. So we're going to credit service revenue, increasing my revenue account for $200 for the amount of revenue earned in June.
Professor Wade?
Yes.
So the debit unearned revenue, is that because that's the remaining balance that we should expect to receive?
No,
Once we
good
do it?
question. Good question. It's not the remaining balance, that's the amount that was earned.
Okay.
The balance that you show here, the balance of your unearned revenue account, your adjusted balance, that's how much is still left to be earned.
Okay.
So left to be earned from June 30th. Sorry, I'm just right, July 1st to July 15th. And this represents amount earned in June. So the balance in your service revenue account shows how much in revenue you earned in June. The balance in your unearned revenue account represents how much is left to be earned because you still have an obligation. Sorry, Prescott. Yes, I can move down. So that June 30th, that's your adjusting entry right there. And just like we did for our deferrals for assets, if it's a deferral that relates to a liability, which is what we had in that second example, what happened to the liability account for the adjusting entry? The liability unearned revenue decreased. And our revenue account increased.
Yes, the liability decrease.
Correct, Warren. We're assuming that it is earned, distributed evenly unless stated otherwise. So if it doesn't say that it was earned at a different increments, like at the end of the month, it's implied that it was earned evenly over the time period. So notice with deferrals, the asset or liability decreases with every single deferred journal entry, and the expense or the revenue account increases with every
Increase.
single deferral. It's a little cheat sheet for you to double check to make sure that's what's happening in the adjusting entry. Okay. You're going to do a practice problem, or at least start it. And it is in the handout on page 3-5. There's a couple of them, actually. Guess I only give you the supplies one. Okay. It's the in-class example for supplies. There's also a prepaid one if you want to practice that as well, right above it. It's on page 3-5 of that handout. And there's two problems. One is covering supplies, and then one is covering unearned revenue. And basically for this one, there's a slight difference in these problems. These problems are looking at for a year, not for the month. So January 1st is the beginning of their year. December 31st is the end of their year. And then, so you're not going to just be looking at it for 1 month, but it may be several months that you're adjusting it for. So let's start on the first one, and then I'll let you guys go for the day. But I want you guys to get started on it because these ones you want to practice. You need to practice adjusting entries. And actually, before I pause recording, chapter 3 is one of the harder chapters. So it may be one that you want to practice a little bit more than other chapters.
Professor Wade, I have a question. You sent us a reminder that today is the first exam.
Oh gosh.
Is it due day?
Yes, Beatrice, you're in a different class. Sorry. If you're in my accelerated 8-week class, yes, that is correct. But everybody, if you're not in my accelerated 8-week class, if you're in my 16-week class, that is not correct.
Okay, how can I make sure in what class am I?
You're in my 8-week class.
Is that possible that if I want to change it, not to be in the accelerated class? Because
I can't manually change it, but you might be able to go to admission for that.
Yes, because I don't think I feel ready, and that's what I confuse with the days, because some of my classmates, they told me other day and I'm supposed to submit it. That's what I feel in so much pressure and sending and try to gather all the information and
wait after class, I'll talk to you about it.
Okay, thank you.
Marisol, I would say that the first 3 chapters are always the hardest in this class because the first 3 chapters are new information and it's a lot of information all at once. There are some harder topics as we move in throughout the class, but once you have these basics down, then it's easier to digest them. So I won't say that the hardest chapters are over with yet, because there is a few in particular I can think of that are a little bit hard, but for the most part, most people feel a lot more confident after the first 3 chapters are done. that help? Okay. Yeah, see, you're almost done with the hardest 3 chapters. See? Comforting thoughts. Christian, yes, it's good practice problems. They give you similar problems for that extra credit assignment. The study guide is actually on the chapter 1 exam page, but I'll go through it in class too. You guys are lucky you get me for 2 whole class periods going over the exam, so you can ask all of your questions then. Don't ask me that question, Jonathan. It's in the syllabus. Sorry. Okay. For the first entry, I'm going to go through it just so we have it, so you can look at it as a reference. No worries. Okay. So on January 1st, they had a balance of $200 of supplies, which they gave you, which is the beginning balance for the year. They started the year with. On March 1st, they purchased $3,000 of supplies. So we're going to debit supplies, asset account, increasing supplies for $3,000. We now have an additional $3,000 worth of supplies available to be purchased, or I'm sorry, to be used during the period. So they have a balance now of $3,200 worth of supplies available. And how did they pay for those supplies?
Cash.
Cash. Didn't say on account, so we're assuming it's cash. And cash is decreased for $3,000.
Decrease.
On December 31st, they counted the supplies on hand at year end, and they had $350 worth of supplies left. So we know that they used a good portion of their supplies, right? Because at the end of the year, they only had $350. Yeah. So a substantially lower balance. How do I get from $3,200 worth of supplies to $350 worth of supplies?
Subtracting 350 from 3,200.
Yep. So 3,200 minus 350.
2,850.
Correct. 2,850 was used. Okay, so we're going to debit supplies expense, recognizing those supplies that were used, 2,050. Credit the supplies asset account for 2,850, reducing the asset. And if I was to run that unadjusted trial balance at 12/31 for supplies expense, it would have a 0 balance. This is an expense account, so it has a normal debit balance. So the ending balance and the beginning balance would be on that debit side. We debit the account in the journal entry on 12/31 for 2,850, increasing that account to 2,850, representing supplies used during the year. Right? So I will leave you with that for the weekend. You have your chapter 2 homework due on Saturday. You can go back and look through the chapter 3 pre-assignment. This may have clarified some things for you. And you're more than welcome to start that chapter 3 homework too if you want to, but you don't have to. Have a good weekend, and I'll hang around if you have any questions.
Thank you, Professor Wade.
You're welcome.
Thank you.